the biggest buyer of treasuries right now is still is foreign buyers, however, through private institutions, and they have not flipped into gold yet to the same degree that we're seeing central banks. I would think that eventually we will. And talking about gold itself, I think, if I would get $1 for every time somebody tries to time a correction in gold prices using technical analysis, we would all be filthy rich. But we gotta call this what it is, and it's a gold rush.
Tavi Costa, Portfolio Manager at Crescat Capital. It is a true pleasure to host you on Palisades Gold Radio.
Thanks for having me. Looking forward to this conversation.
Definitely. Really excited for this chat, Tavi. You're, of course, the man behind very famous charts like this one. I'll pull it up in just a second. And that spread like wildfire in the precious metals community. But before we talk about that, I would love to talk about you for a second, the man behind the charts, really what your background is and how you got into this industry.
My background, okay. So I was born and raised in Brazil, and basically got an MBA from my dad's business that basically had a bankruptcy when I was 13, 14 years old. And that was a very difficult moment, but I learned a lot about building a business with him. And so from there, I decided to look at money as a whole from a perspective of security. I went through a lot of inflationary eras in Brazil. Brazil has always had inflation throughout my life growing up there. When I moved to the US, I moved it mostly not because I had the money to move here. I moved here because I was a tennis player, became a tennis player, and was able to get recruited to play tennis at a Division I school in the US. When I moved here, I fell in love with finance and fell in love with investments. I couldn't get enough reading on especially newspapers. I was fascinated by the dynamic of this industry and how things change over time. Learn about cyclicality, learn about macro. Realized there was not a lot of people covering macro in general, especially my age. And it's a lot easier to become an expert when there's no experts around you. So I went deep into that and not calling myself an expert at all. End up working, finally getting a job at a hedge fund at Crescat, and started my work as an emerging markets analyst. We worked on a very big theme at that time, which was that China was going to have its own Lehman Brothers moment back in 2014, 2015. That has panned out very well. We made a good amount of returns at that time for funds and clients during that period. And after that, in 2018, 2019, I really was struck by a chart that showed the depression of capital spending in the commodity space. Was fascinated by that, thought it was the time to be deploying capital into natural resources, didn't know which one exactly, was looking for a way to express that view, and realized how mining, the duration of getting new supply into this market is so complicated. Average mine takes about 15, 12 years to go from exploration to production. And that's usually why it reflects on the duration of this industry. So we launched a fund to invest in mostly exploration companies. And that sort of took off from there. And it's our main product. And also back in 2022, we acquired the fourth largest silver mine in the world. And that was a leverage buyout where the partners and also other partners and the funds themselves are the largest shareholders. And now we manage, when I say we, one of my partners is the CEO of the company today. And it's been a wonderful endeavor. And right now I'm working on that and also working on potential new acquisitions of multiple projects, and so it's very exciting and hoping to stay in this industry throughout this whole cycle.
Inspirational story, and of course nothing teaches you about inflation like experiencing inflation in a country like Brazil. Talking about, do you think your main edge is macro? Is that really your expertise?
Look, I think the main thing I learned in this whole industry is you have to be extremely well grounded to have very independent views. I've always said this, you can always borrow my thesis, but you cannot borrow my conviction. And conviction is something that really evolves. And once you have it, you're able to act at times when markets have a lot of stress. If gold prices decline 30-40% from here, would people be buying gold or be scared out of the trade? Once you have this optimism around us, it's easy to say I would be buying it. But there's plenty of assets out there that have similar attributes in terms of the compelling thesis behind it, and people are dismissing today. And so it's always going to be the case. And so I think that my biggest ability, if you will, I'm also learning just as much as anybody else. But maybe my biggest ability has been to be able to find these turning points in markets from a macro standpoint to create long-term thesis that I can then express those views. And the China moment, that was a big one. That was way before most people were talking about China as being a threat to the whole world in terms of dependency in reliance on industries and all sorts of things. And a lot of people thought China was going to take over the world, and I thought China was closer to implosion. So we've seen that work, right? And that had a lot of major implications in the global economy. The same thing happened with this commodity trend. I had no idea we were going to have COVID, that policymakers would print as much money as they did. That certainly caught me out, on surprise as far as the size of that and the magnitude of how they and the speed that they acted. And so I've been able to see these sort of, and that's just by doing a lot of work, independent analysis. Turns out that the best way to be independent is to do your own work. Does that sound obvious? But it's funny that people want to read other people's research and then come up with original thoughts. Like, no, you have to dive in, from the very beginning on your own, and then you sort of form that view and learn a lot about different types of opinions that are out there. And I see a clear run today. Well, I think this big bull market in gold is been acknowledged by a lot of people. And just to finalize the thoughts, like the same way mining was maybe 3 to 4 years ago in terms of valuations, in terms of the clearness of the trend that we would likely be given the macro constraints we had at that time, I would say that the emerging markets are in that place today. Like, I would be shocked if in 3 to 5 years, emerging markets, especially Latin America, is not substantially higher in prices of those assets like miners are today. That doesn't mean miners are not a great opportunity. They're an outstanding opportunity, but these things come on waves, and people are all focused on the thing that is coming now, but there's always unintended consequences of all this. And I can clearly see another trend here starting to develop while people are just dismissing this whole thing.
Today's episode of Palisades Gold Radio is proudly brought to you by our parent company, Palisades Goldcorp, Canada's leading junior resource investment vehicle, trading on the Toronto Venture Exchange under ticker symbol PALI. With equity and warrant positions in over 200 companies, ownership of mineral projects and royalties, and a 15% stake in newfound gold, Palisades offers investors powerful, leveraged exposure to precious metals, uranium, copper, and other critical minerals. Palisade shareholders directly benefit from our team's extensive industry knowledge and access to deal flow, opportunities historically reserved for a small group of investors. To learn more, visit us at palisade.ca and join us in our mission to level the playing field for investors. Now, back to the show. Tavi, please talk to us about gold for a second. This chart, of course, spread like wildfire in the precious metals communities. Really, why do you think it spread so far, and what does this chart tell you?
It's funny, I worked on a lot of charts and I post a lot of charts, and you never know which one's going to get around. I've been surprised by some of them, and surprised as well by things that I find extremely interesting that I posted and people don't find it interesting. Those are the most interesting ones, to be honest. This one, I think the biggest part of it is the fact that we're crossing, right, a historical moment of which central banks are choosing to hold more gold than treasuries. But the big part of this research piece was really the fact that nominally, central banks are selling gold, and the big buyers of treasuries today, selling treasuries, they're buying gold and they're selling treasuries. The biggest buyer of treasuries right now still is foreign buyers, however, through private institutions, and they have not flipped into gold yet to the same degree that we're seeing central banks. I would think that eventually we will. And talking about gold itself, I think, if I would get $1 for every time somebody tries to time a correction in gold prices using technical analysis, we would all be filthy rich. But we got to call this what it is, and it's a gold rush that we're seeing. And while myself and others try to go back and look at the 1970s and the early 2000s as a way to explain and maybe guide us to where we could go, the imbalances that are really forcing central banks to buy and accumulate the metal to the degree that we're seeing are far worse than those periods. And if you use that logic, we just haven't seen anything yet in the gold space. So I suspect this has got real legs, and we're probably in a very constructive environment for companies that produce the metal. So it's going to be a really interesting decade for those that are paying attention to those trends.
Yeah, 100%. This one has legs. What surprises me about the precious metals market every time I look back into the history is how long these bull markets can be, the secular bull markets. And perhaps that's also what this chart plots gold versus US equities, really these long-term reversals in trends in which we might be in one right now.
Yeah, and I think we all make mistakes as investors. I think my biggest mistake as an investor has been being too bearish on equity markets in the US. But I can't help but consider the idea that we're very close to a major rotation out of US equity markets, given how much valuations have gone up, and don't usually see these levels of valuations stay there for too long. But maybe this time is different. I'm not willing to take that bet. I think there are situations when this time could be different in many things in markets. But the real question is, are you willing to make that bet at these valuations, right? It's not like you're making that bet at one of the cheapest valuations in history. That's a completely different story. You're taking a major amount of risk to say that these valuations will stay where they are, and you're paying 50 times revenues in some cases of these companies. And so, look, I just think that the biggest risk we have right now in the mining space as investors in this industry is, to me, how do we hold to our shares and hold to our investments without being scared out of the trade by trying to be too cute, timing corrections and all sorts of things. Because the valuation proposition we may have in terms of how investors may perceive these companies at some point might be very different than our normal discounted free cash flow calculations that we tend to do. I mean, think about how the technology space works. Does it work from a free cash flow discounted model standpoint? No, that's not how these guys value this. This is why we as value investors, when we look at these investments, we're like, this does not make any sense. Why are people paying this for that? It's because major capital allocators have applied a different way to value these companies. For how long, we don't know, but they have been doing this for a while. And I think it's only normal for us to consider similar situations in the mining industry if we're going to get in a world where it's not about how much money you make, but rather how much metals you have in terms of security of metals from a sovereign perspective. And as you get to that world, valuations can run wild. And so I'm very open-minded to what we could see here in the mining space.
Really interesting, and I would love to talk about gold miners and silver miners more in just a second. But first, I would love to take you to silver. There's another chart that you've made that went quite well in the precious metal space, got retweeted a lot on X. This 45-year-old cup and handle pattern. Do you think really that technical analysis plays out over a 45-year time frame?
Yeah, I think the cup and handle formation is one of the most interesting formations we see in markets because it actually plays out in real life. You think about our own lives and people that have done very well in different things in history. Usually they've had a big fallout after a small win, right? Or a big win. So you have a big win in life, that's your first part of the cup and handle, and then you have your depression, if you will, moment where things don't go as you expected and you have a big lesson, whatever that lesson is for you. And so you come back and you regain that position that you were before in terms of, positive position. And you basically retest that peak level that you initially got to. And that's your cup, right? But then for whatever reason, you get hit again. But this time you get hit by whatever external purposes are, and you're much more aware of it, and you're much, probably ready, I guess, and experienced to cope with those issues. Therefore, your dip is not as profound, and that's your handle. And so this is kind of what we're seeing in the silver space. Of course, I'm not talking about silver as having its own life. I'm just talking about from how we can relate to some of these technical patterns, which are nothing more but human behavior being, basically priced into the markets overall, financial markets, which has a lot to do with how prices work. And that's why we got to think about, economic behavior, because it's a very important aspect of pricing things. And we're now in the process of a situation where silver prices have been rising for some time now. But if you look at the supply side of it, of which tends to have a lag, so when you have a couple of years of performance in the silver space, then finally you have a catch up on the supply side. The difference of this cycle is that we're not seeing that, right? Because we know for a fact that there isn't enough silver exploration assets that will really drive supply to a very different place. And because these metals are constrained, from a resource standpoint. And so we're going to get in a world where, these things can have their own wild movements because of the lack of supply, and the demand is surging from many different angles, not just industrial, but monetary, inflationary, and others. And so you have to be very open-minded to a world where silver will likely break out from prior peaks and go well above that, similar to what gold has done. And if that's the case, it would be very plausible to see triple digits in silver and other crazy numbers that may not sound as crazy when you're starting to really put together, the potential intrinsic value of this metal in a world where central banks cannot afford to raise interest rates and fight inflation because we have to suppress things at all cost. So in that world, silver doesn't belong to $40 an ounce in my view. And it's really attractive to see this movement happening and the potential breakout from a major cup and handle at a time when to gold to silver ratio still is at about 80, which is a historically high level, making silver extremely cheap even relative to gold. So yeah, it's a very bullish environment in my opinion.
Some great points there. And of course, if you look at inflation since the 1980s, if you adjust $40, $50 to today, you are talking triple digits like you started to outline there.
Yeah, it's very possible, and I think that you have to ask yourself how much can a producer, have in terms of cost structure in this environment. And majority of the silver miners are producing sub $20 an ounce. So, yeah, I mean, these companies are going to become, in my opinion, real cash flow machines. And it would only be suitable if that happened, given the fact that literally 1 or 2 years ago, or maybe 6 months ago, or maybe 3 months ago, the whole world, outside of a few group of folks, was saying that mining companies never make any money. Wouldn't that be interesting if in the end of this decade, people have a complete different perspective about that? That's usually what markets do to you. You have to be very flexible in your views. And I've heard this so many times. Why would I buy miners if I can just buy gold and silver? I don't want to mess with the operational risk. I don't want to mess with companies that only bleed capital. Well, maybe they're learning a lesson. There's something called leverage. And leverage works both ways, in a positive way and a negative way. If you think gold prices are going to keep going higher, which I do, for the next 5 to 10 years, then the miners is your best bet, right? Because as long as their cost structure is remain somewhat manageable, right? Given the run up in prices, these things are mining gold at, $2,000 an ounce in the worst cases right now, and some of them at 22, 23. And yeah, I mean, there's still companies that they're producing at sub $1,000 an ounce, believe it or not. Then that's insane, So yeah, this industry is going to get, I think, a lot of institutional attraction. And once again, it's not because the industry has structurally changed. It's just because we're just at the right time of the cycle, most likely. And this one might last another, 5 to 10 years, in my opinion.
100%. And of course, a picture shows 1,000 words. This is really what you were outlining there. Of course, your chart as well. Gold price shooting up, all sustaining costs remaining relatively modest, also going up. And you could have a scenario where the gold price accelerates, or at least continues to go up, and the all-in sustaining cost also goes up, but that margin keeps increasing, right? And even right now, at the current prices, according to this chart, you're looking at over 50% profit margins. That's better than some internet companies.
Oh yeah, I mean, I think there has been, a lot of the prices in miners have been driven by projected free cash flows over the last year or so, and I would say over the last 6 months or 3 months, we're finally seeing the realization of those projections and being actually above estimates, given the fact that everyone's so skeptical about this industry. Again, it was only normal to expect that people would, have very low estimates for where those earnings would be. And we're seeing blowout earnings, like things that, some of these companies are very mismanaged even, and are also being able to generate cash flows to a degree that they have never done in the past. And yeah, I think that if you're a mining company, you really want to be not sitting on your back right now. Your goal as a company is to protect that margin at all costs. That would be what I would strongly suggest any board of directors. Like, that would be the biggest discussion they all should be having. How do we protect these margins moving forward? Of course, every mining company will have their own way to do it. I'm gonna offer a very simple one that could be the beginning of the discussion, which is on the energy side. Some of these open pit projects that have very large, call it 30% of their costs coming from energy, should consider having some level of hedges in their energy exposure. Because at some point, this very extreme gold to oil ratio, silver to oil ratio, copper to oil ratio is not going to last. We're probably going to see oil catching up. And if you can get in a world where you can give up a little bit of your gains to make sure you protect your structure of cost the best way as possible for the next 3 to 5 years, you should definitely be considering this. Once oil is at $100 or $90, the cost of that hedge will not be the same. In fact, it will be not only expensive, but your margins would be contracting as a result. So as a fan of this industry, and I love things that are, call it legacy, businesses. What I thought was fascinating not too long ago is that people would come up to me and say, just absurd things that the mining industry would die. Like, you kidding me? If there's one industry that is not going to die, is the mining industry. We cannot afford that, right? I mean, I remember seeing someone come up to me and say, Tavi, do you feel okay as a person being involved with the mining industry? And that person was in the process of buying their second home. I looked at her and I said, aren't you buying a second home? Where do you think this material to build your home is going to come from? Let's just use logic here. And so a legacy industry that is in the process of seeing secular change in metal prices, and there's a lot of mismanagement, there's a lot of issues. I'm not saying there isn't, but there's also a lot of opportunities here. And if we can learn how to manage risk, which there are ways around it, look at other industries that have done this very well, and even the energy companies at times, I think this is going to be a very elegant way of expressing your view on the major devaluation of fiat currencies over time.
Thank you, Tavi. I would love to talk about you and Crescat Capital for a second. If you look at the GDX, which is an index really tracking gold producers, it's up 120% year to date. How are you positioning yourself right now? Are you guys taking some profits as we speak, really de-risking your positions? Or are you still finding a lot of value opportunities to plow some capital in and try to generate some alpha?
I think Crescat is in a bit of a different part of the industry, because we're obviously investing in the idea of early stage companies that are onto what we think are going to be major discoveries. So we are always redeploying capital into companies that are improving intrinsically, and the prices are not reflecting that. So if there's any rotation of capital within the portfolio, is reflecting that idea. So just want to make sure of that. That nothing that we do in terms of selling and buying is driven by the idea that we're at the end of a cycle or anything along those lines. Definitely not the case. I think there's plenty of opportunities today in the markets, and exploration would be one of the most critical parts of this space because of the embedded growth you tend to have during times of bullish periods, and also during times of excitement over new discoveries. And we've had pretty much success every year on finding discoveries. So I think we want to keep that moving that way, obviously, and very focused on the process. You never know which company that you will be acquiring and owning would be the ones finding new mineral discoveries. But it's, I think, it's a venture capital approach in the mining space that is underappreciated, because you can improve your odds of success by being an activist and trying to deploy different forms of improvements in those companies, from exploration, project designs that you can be part of, how do we spend the capital, and helping management to make the right decisions, especially from access of capital standpoint and other things. So yeah, it's I think there's going to be a lot of value to be created in that part of the industry.
And perhaps it's also playing into this chart, really seeing a gold miner junior to senior ratio and a breakout that you've outlined here. And we could see a huge reversal there, and juniors appreciating compared to those seniors.
Yeah, I think that chart reviews an opportunity as well regarding, that we're over, I think it's 50%, 53% relative to where we were in the prior peak of this cycle when it comes to juniors outperforming seniors. And the idea of investing in the mining space or anything is always an exercise of risk and acceptance of that. And we accepted the risk of buying gold, we as society, and therefore why gold prices have moved up. We're in the process of accepting the risk of a higher and more volatile space like silver and copper and others. We are becoming very, very comfortable in buying royalty companies, consistent cash flowing companies, and others. And as we continue to think that gold prices belong to these prices that we're seeing, we're also going to, in my view, organically get to the point that we're going to feel comfortable in the exploration part of the industry, as we are likely also to see a major M&A activity driven by seniors making too much money, looking to acquire projects that are already somewhat explored and have a lot of potential for them to take those companies into production. So we're going to see a lot of that happening probably in the next 5 to 10 years.
Tavi, I would love to talk about oil with you for a second. You seem to be slowly but surely becoming bullish on energy, on oil and gas. And that seems to be contrarian compared to the general market, who is either discussing peak oil, that we've passed that moment and are therefore bearish on oil, or they're talking about a potential slowdown in the economy, which could also negatively affect oil. So really, why are you slowly but surely becoming bullish on energy?
Well, I think, as you said, is a contrarian opinion. Then I'm not trying to be a contrarian for the sake of being one, but rather because there's many reasons to justify that view. And prices help me to be, very attracted to these assets, because I can acquire more of them given how undervalued they are today. I love things that have done very well in the past, like very recently, since early 2000, since the 2020s, after the recession, oil had a big run that went all the way to 2022 during the Russian invasion. And from that period, we've been in a consolidating moment, especially for energy companies. And the same bulls that were bulls right at the peak of that market are now bearish. And these companies have, I would say that in terms of popularity, have lost completely momentum on that front. And I think they offer an outstanding way of hedging a very large mining exposure that I have in my portfolio. Just like a mining company that should be hedging their energy cost, I view that the same way here. And lastly, I think there's many reasons to also make the case that energy is cheap. You can start with the fact that in the Permian in the U.S., that basin is starting to see number of drill rigs contracting. The usual, come back to that argument is that we're seeing also companies become more productive and more effective, which has been true. That's just an absurd comment when you're seeing a 30% decline in oil rigs. That's not driven by productivity or efficiency. That's driven by companies not being able to afford exploring and producing at these price levels and having to reduce that. And that's not yet reflecting on production because there's a lag into those things. And I just find that people are just very off on that view. Like, yeah, it's fascinating to me that, people like to take that popular view without giving some critical thinking here. It's too easy to think that it's just all done by productivity. I mean, it's not. I mean, the productivity side of it, you can see that the peaks of number of oil rigs have been lower. But the trend, when it starts to fall apart as much as it has been, it's not driven by that. It's driven by the fact that these companies cannot afford being at these levels. And so eventually that's going to drive prices higher. And I would point out to what's happening now. We have one of the lowest inventories of oil in the US in history. We have SPR, or Strategic Petroleum Reserves, that are also one of the lowest in history. We're starting to export oil to one of the largest degrees in history. So think about you in the US, one of the lowest inventories, getting oil out of the ground, companies reducing their operating rigs, which will eventually drive lower production. And the prices of all these things are not reflecting all these changes. And I think that's crazy. And on top of it, we have a world that is as complicated as it could be when it comes to geopolitical risk. And in my view, there's zero political or geopolitical risk premium being priced in markets right now. So yeah, that's why I'm very bullish. And then on top of it all, before somebody wants to add to that thesis, think about the AI revolution and onshoring. You think we're not going to use it more energy? You're out of your mind if that's your view. Nat gas and oil are going to be a huge part of this. And so will be solar, so will be nuclear, so will be other things. But the energy space is just not priced for that. And technically, we're starting to see moves like breakouts in small companies, ETFs, larger companies, and look at the energy stocks to oil ratio, right? Think about the acceptance of risk idea. People are accepting the risk of buying energy companies and not buying oil. It's basically a reflection of the market where investors are being okay deploying capital into that part of the market because they have a view over the long term. And I think that's just getting started. I don't think the oil space is done here. And in fact, I think it's one of the best, medium-term setups I've seen for this industry in a very, very long time.
Being cognizant of the time, Tavi, where's the best place people can follow you and keep up with your work?
They can keep up with my work on Twitter or X at Tavi Costa, or LinkedIn, Tavi Costa. You can find me there. Or you can also read our letters and our content, which is at crescat.net as well.
Tavi, tremendously appreciate your generosity with your time and your insights today.
Thank you very much for having me.
This podcast is for general information purposes only and does not constitute investment advice, an offer, or solicitation to buy or sell any securities. The views expressed are those of the host and guest and do not necessarily reflect the views of the company or their affiliates. Guests on the show are not compensated for their appearance. Certain discussions may include forward-looking statements subject to known and unknown risks and uncertainties that could cause actual results to differ materially. Listeners should do their own research, consult a licensed financial advisor, and not base any investment decisions solely on the information discussed. For a full disclaimer, please visit our website, and for full disclosure and risk factors of any companies referenced, please see full available disclosure and risk factors on their SEDAR Plus at www.sedarplus.ca.